All right, if you care about metals, markets, or honestly just how fast money can disappear, stay with me for the next 15 minutes, because this just happened. Silver didn't drift lower, it didn't gently correct. It dropped from about 120 down to 99 in what felt like a blink. We're talking roughly 20 bucks gone in hours, with most of that damage packed into a very tight window. And here's the part people are already getting wrong. This wasn't about physical silver suddenly being unwanted. The real trigger isn't what the headlines are screaming. I'm going to walk you through what actually broke, why it broke right now, and how you can spot this setup before it hits again. Because if you understand this pattern, you stop being surprised by moves like this. If you're holding silver right now, if you're watching from the sidelines, or if you're just trying to make sense of why markets feel so violent lately, you're in the right place. Your job is to understand the mechanics, not just react to the price. Before I explain what caused this specific drop, let me teach you something most people never really internalize about markets like silver. Price isn't just about supply and demand in the real world. It's about positioning, leverage, and timing. Think of the market like a crowded theater where everyone's leaning forward because the show's been amazing. As long as nobody moves, it's fine. Everyone's comfortable. But once a few people suddenly stand up and head for the exit, what happens? The aisle gets clogged fast. People push. Someone trips. Now everyone's rushing. Futures markets work the same exact way. When too many traders are leaning in the same direction, even a small shove can turn into a stampede. That's what leverage does. It amplifies emotion, it compresses time, and it turns what should be normal pullbacks into violent moves that feel like the floor just disappeared. So, what does that tell us? It tells us that when you see a parabolic move like silver just had, you're not just watching supply and demand anymore. You're watching a crowded trade. You're watching positioning. And when positioning gets extreme, the unwind doesn't happen politely. If this is making sense and you're seeing markets differently already, drop a comment below and let me know where you're watching from. I want to know who's paying attention. Now here's what's actually happening under the hood, and this is where it gets real. Silver had just gone on a parabolic run, straight up, fast, powerful, beautiful if you were long early, terrifying if you were late. When markets move like that, they attract momentum traders, short-term funds, and a whole lot of leverage. These aren't your long-term stackers. These are traders using margin, using futures, using leverage to multiply their exposure. They're betting the move continues, and as long as it does, everyone's happy. But here's what changed. The US dollar started ripping higher again, and yields pushed up. That combination matters more than most people think, because a stronger dollar tightens financial conditions globally. It makes commodities more expensive in other currencies, and rising yields raise the cost of holding leverage positions. You're paying more to stay in the trade. So, when silver failed to hold the 120 level, that wasn't just a technical line on a chart. That was a psychological anchor for a lot of positions. That was where stops were sitting. That was where margin calculations were built. That was the level people pointed to and said, as long as we're above this, we're fine. So, when that level broke, stop losses fired. Automatically, no emotion, no second guessing, just execution. And margin calls followed right behind. If you're leveraged and the price moves against you fast enough, your broker doesn't ask nicely. They liquidate your position to protect themselves. And once forced selling starts, it feeds on itself. This is critical to understand. Liquidity thins because market makers step back. They see volatility spiking and they widen their spreads. They're not going to catch a falling knife. Bid-ask spreads widen. Each sell order pushes price further than it normally would, because there aren't enough buyers stepping in at every level. That's how an orderly pullback turns into a cascade. You go from, okay, we're pulling back a bit, to, wait, what just happened? In minutes. Here's what's wild about this. The speed of the drop tells you it wasn't a slow reevaluation of fundamentals. Nobody woke up this morning and decided silver's long-term value proposition changed overnight. This was stress. This was paper positions, unwinding all at once in a narrow time window. You can see it in the volume spikes. You can see it in the intraday volatility. You can see it in how fast the move happened and then stabilized. That's not organic price discovery. That's forced liquidation. But here's the part that should make you nervous if you're not paying attention. These cascades don't warn you politely. They don't send you an email saying, hey, In 3 days, we're going to drop 20%, so maybe tighten your stops. They happen when everyone thinks they're safe. They happen when sentiment is still bullish and people are calling for $150, $180, $200 silver. That's when positioning is most dangerous. Because everyone's already in. There's no new money waiting to buy the dip. There's just over-leveraged longs hoping it keeps going up. Now let me show you what very few people are talking about right now. The dollar's move wasn't random. It came alongside headlines about tariffs, about trade tensions escalating again, about uncertainty in global markets. And when uncertainty rises, where does money flow? Into the dollar, into treasuries. It's the reflexive safe haven bid. And that creates a headwind for everything priced in dollars. Commodities get hit. Precious metals get hit. Even though silver and gold are supposed to be safe havens themselves, in the very short term, the dollar can override that narrative, especially when you've got leveraged positions that need to be unwound fast. Now, zoom out with me for a second, because this isn't new. This is the same playbook we've seen over and over. Think back to silver in 2011. Remember that? Silver screamed from mid-20s all the way up to $49. Everyone was calling it the trade of the decade. And then what happened? It collapsed. It went from 49 down to the low 30s in days. Why? Because margin rules changed, because leverage cracked, because positioning was extreme and the unwind was violent. Same pattern, different year. Look at gold in 2020 after that vertical run. Gold went from around 1,700 up to over 2,000 in a hurry. Momentum was incredible. And then it stalled. It pulled back. Not because the fundamentals changed overnight, but because positioning got extreme and profit-taking started. Or even oil in 2018. Remember when oil was rallying hard and then financial conditions started tightening and it just fell off a cliff? Everyone was calling conspiracy. Everyone was blaming someone. But the pattern was the same. Extreme positioning plus a macro shift equals violent repricing. Every time this happens, the narrative changes after the fact. People argue manipulation, they talk about conspiracies, secret meetings, bullion banks shorting paper contracts. And look, sometimes there's smoke. Sure, I'm not here to tell you markets are perfectly fair, but the pattern is always the same. You don't need a villain in a dark room to explain what happens when too many people are on the same side of a leveraged trade and conditions shift. Markets don't need a conspiracy. They just need imbalance. They just need stress. And when you look at the pattern across different assets, different years, different conditions, you realize this is how markets work. This is the cycle. Now, let me be skeptical for a moment, because I want you to hear independent thinking, not just hype. Could this move mean something deeper? Absolutely. Could it be an early warning that financial conditions are tightening more broadly and we're going to see stress in other markets? Yes, that's on the table. I'm watching that. Could there be large players using thin liquidity to exit fast, knowing they can push price and get out before retail even realizes what's happening? That's always possible. I've seen it before. Could this be coordinated? Maybe. But here's the thing about calling everything rigged. It doesn't help you trade better. It doesn't help you position smarter. It just makes you angry, and anger doesn't make money. What helps is focusing on what you can actually observe and measure. Leverage, positioning, liquidity, macro pressure. Those are real. Those leave footprints. You can see them in open interest. You can see them in volume. You can see them in how price behaves at key levels. That's actionable. That's what you can build a strategy around. So, yeah, stay skeptical. Question everything. But focus your energy on what you can use. There are probably 3 types of people watching this right now. Maybe you're long silver and you're angry or stunned, wondering how this happened so fast. You were up, maybe significantly. And now you're watching those gains evaporate, or worse, you're underwater. If that's you, I get it. I've been there. Your job right now isn't revenge trading. It's not doubling down to prove you were right. Your job is survival. Reduce leverage if you're using it. Reassess your time horizons. Are you a long-term stacker who believes in the fundamentals, or were you trading momentum? Because those are different games. Separate the long-term thesis from short-term mechanics. The thesis might still be intact. The mechanics just hit you in the face. Maybe you're on the sidelines, feeling validated for not chasing the top. You watched it run and you thought, this looks stretched. And you were right. If that's you, don't get cocky. Seriously. These resets often create opportunity, but only if you wait for volatility to compress and signals to stabilize. Don't try to catch the falling knife. Let it land. Let the dust settle. Watch for signs that forced selling is done and real buyers are stepping back in. That's when opportunity shows up, not in the middle of chaos. And maybe you're new. Maybe you're just trying to understand why markets feel so unfair, why things move so fast, why it seems like every time retail gets excited, the rug gets pulled. If that's you, this is the lesson. Markets reward preparation, not certainty. They reward people who understand mechanics, who manage risk, who don't over-leverage. The universal rule for all of you, no matter where you are, is the same. Respect leverage and respect liquidity. Because when both turn against you, there's no mercy. So, here's what I want you to answer in the comments. Where are you right now? Are you holding? Are you waiting? Are you rethinking your approach? I want to know what you're learning from this because that's how we all get better. So here's where I stand. I'm not panicking, and I'm not blindly buying the dip either. I'm watching a few things very closely. First, I'm watching whether the dollar keeps strengthening or stalls out here. If the dollar rolls over and starts weakening again, that removes a major headwind for silver. If it keeps ripping higher, we could see more pressure. Second, I'm watching yields, 10-year yields, real yields, because they tell you how tight the financial screws are getting. If yields keep climbing, that keeps pressure on leverage positions across the board. If they stabilize or start coming down, that eases conditions. Third, I'm watching open interest and volume in silver futures to see if this was true capitulation or just the first flush. True capitulation looks like open interest dropping sharply as positions get washed out. If that happens, it clears the deck for a cleaner move later. If open interest stays elevated, there might be more pain coming. The way I see it, based on my analysis, this move was mechanical, not emotional. It was structural, not fundamental. The long-term fundamentals for silver didn't vanish overnight. Central banks are still buying gold. Deficits are still massive. Real yields are still historically low by long-term standards. Industrial demand for silver is still strong with solar and electronics. None of that changed. What changed was positioning and conditions. That's a reset, not a collapse. If history rhymes, and I think it does more often than not, this kind of reset clears weak hands before the next real trend emerges. It shakes out the over-leveraged, the late chasers, the momentum-only traders. And then, when conditions stabilize, the people with conviction and capital step back in. That's when the real move happens, not the parabolic blow-off, the sustained trend. I'm not a financial advisor. This is not financial advice. I'm sharing my perspective based on patterns I've studied and markets I've watched for years. Do your own research. Build your own thesis. Make decisions that fit your risk tolerance and time horizon. If you made it this far, you're in the top percentage of people who actually want to understand how markets work instead of just reacting to them. That mentality will serve you well. It'll keep you in the game when others get shaken out. If this helped you see the bigger picture, hit that subscribe button and share this with someone who needs to hear it. We're building a community of people who think critically, who question narratives, and who stay ahead of the crowd. Stay sharp out there, think critically, verify the data yourself, and make decisions that keep you in the game.